When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Hogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Hogan. And now here's Jeff Hogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Hogan, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about Americans' economic expectations have hit the lowest level in 12 years. Also, how to tell if your annuity is wrong for you. We'll answer some listener questions, and then finally, costly mistakes retirees can make by not consulting a financial advisor. My name's Jeff Shade, and as always, I'm just here to ask the questions, but the words of wisdom and solid advice come from the other Jeff in this radio program, Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
Doing great. Always fun to be with you and the listeners and just get this weekend going.
That's right. It's April already, Jeff. I mean, the license plates, they haven't begun to turn just yet. When do the snowbirds go home for the most part?
Well, they're starting to trickle out, but based on traffic this week coming and going to the office, I would say they're not gone yet, or there's still people trying to get a last-minute vacation down here. Maybe they're coming down from cold country and getting a last-minute vacation before it gets too hot to think of Arizona as a vacation spot because it turns too hot in a few weeks.
Right. Well, Oro Valley is a great place to live, and as is all of Tucson. Of course, we cover all of Tucson. You and I know a little bit more about Oro Valley, and, up there they say when the mountain turns pink, it's time to have a drink or something like that.
Yes.
I'm just learning all that kind of stuff.
The sunset on Mount Lemmon. Yeah,
That's it.
As soon as the sun goes down, the gold goes to pink.
Well, anyway, hope everybody else is having a great weekend. We appreciate you joining us here for Premier Retirement. Jeff, let's get started with our first topic today, and that is American economic expectations have hit the lowest level in 12 years. A lot of people are worrying about the uncertainty brought on by President Trump's policies and the higher prices due to tariffs, and this worry and uncertainty are the main drivers for low expectations for the economy. Do you think that most people who are worried about this thing really have a basis to be worried, or is it just too soon to be worried?
Well, I think everybody should be worried. Change always creates, uncertainty and change is an uneasy feeling, and it doesn't take very many uneasy feelings to get people to start scaling back on their stock investments and risk and start wondering if maybe they're leaning too much into risk. I think people have been leaning too much into risk anyway, just based on the valuations and the fact that not just the consumer expectations about the economy have been bad, but pretty much every quarter for the last 2.5 years, every month, in fact, the leading economic indicators have been going down, down, down. Manufacturers have been going down. We've got so many things that are, getting worse because we've been shipping out our economy to other countries. In fact, if you look at that graph on economic indicators, it looks kind of like a stock graph where you have highs and lows, but the graph, the highs are lower and the lows are lower, meaning that even on the rebounds, the economy never rebounds to where it was before the last downturn. And we've had a downtrend of about 30 months. And generally speaking, when the economic indicators, that means like everything from housing starts, new mortgages, to just housing sales, to job growth, to income growth, to manufacturing production, prices, all these different things that we can look at. There's about 10 or 11, I don't know how many parameters, but I think there's more than 10 leading economic indicators, and added up, they make an index. And if that index goes down because things are declining rather than going up, and that might mean we might have housing starts go up, but housing sales go down. So that's one up and one down. But overall, the index all have, weighted score. And when that index comes in, it's been coming in lower pretty much just on a regular basis for almost 2.5 years. The consumer anybody paying attention should have already been a little bit worried and known that the expectations for the economy are not that good. However, all the things that Trump is doing are to fix that economy. I think we should have great hope, not necessarily for the next few months or next few quarters, but I think for the next 4 years and beyond, if he can get done what he's starting to do, tariffs are a good thing. Look at all the manufacturing jobs that are committed to come back here. You've got countries like Saudi Arabia committing to $1 trillion of infusion of capital to America. Why? Because they want to produce oil and different things that you're going to get taxed out of in order to preserve their businesses, to basically be on a more level and fair playing ground so they can continue to utilize the American consumer, which is the highest spending consumer on the planet. If you look at America in general, we consume more than anybody does, including China, who's got more population. But from the standpoint of just how much we go through in the U.S., especially on a per capita and just as a total basis, nobody can afford to have business shut down with America, especially if they're importing their goods to us. And if we're not charging them any tariffs to export goods to us, but we can't export any of our goods to them because they raised their tariffs so high on us. Like if they have 3, 4, 5, 600% tariffs on us, we want to sell them a widget and it's $6 and they charge $60 just to get it into the country because their guys want to make 50 on the same thing they build for $5. There's no way we can sell widgets in those countries. So in other words, no wonder production has gone away in the U.S. is because this imbalance of trade and imbalance of tariffs. Trump wants to fix that starting just this week. He started laying down the law on who's going to pay what and how even it's going to be. And, we could give some concessions here and there. And I think we're going to see some moderation in the initial kick upside the head with the tariff in American Independence Day because we're finally getting our money back and not getting ripped off anymore. But look at the trillions and trillions, seriously, Apple, billions of dollars, all the infrastructure that's going to come of it, all the jobs that are going to come of it, all the jobs that are going to be returned, all those government employees that are losing jobs are all scared about losing jobs, the ones, especially those that don't work, but they'll just making some cuts. And I think they're good cuts. But I think there's also some government agencies that are fat and waste taxpayers' money that are unnecessary, like the education department, things like that are going to be scaled back. That doesn't mean education is going away. It just means it's going to be done more efficiently. But there's a lot of people that are going to need jobs. Isn't it great that there's trillions of dollars of economy coming back to the U.S. that are going to need jobs filled? I mean, good high-paying jobs, people that have to run things, manage things, direct things. Manufacturing jobs are fairly high-paying jobs. So if you look at all the things that will come of the changes that a billionaire businessman and other billionaire businessmen that are working around him, I mean, look at all the people in that DOGE committee, not just Elon Musk, but all the people that we've seen on the news talking about how they're making cuts, what they're finding, how they're finding the waste, the fact that there's only one bank account in the Treasury and all the bills get paid from it. Nobody knows where those bills go. They just know that they go. And there's no accountability. There's no accounting. And no business on the planet can run that way. But the American government does. And I don't know how, but it's been getting away with it. And that's why it's so wrought with fraud and just the mismanagement and waste. And I'm glad that they're going to stop that. So I think from all those standpoints, we've got to be optimistic about the economy and look at the future as being such a better place to play in America, in the business game, in the business world, in the go get a job world, in the I can get a raise and not pay more taxes. I can spend more money on my family, keep more in my own estate and take care of the things that are most important to me rather than take care of politicians and their cronies and send most of my money overseas because the only way to exist on this imbalanced playing field with the trade and economics worldwide has not been in our favor. And so it's been sucking a lot of the gas out of the balloon, so to speak, or sucking a lot of the energy out of the American worker, I think, and the American entrepreneur. But I think that's going to come back with tax savings, with a better economy, with costs coming down, with a chance to export goods to other countries where we haven't had that ability to do so. Other countries are going to come here to produce so that they can export back to themselves and maybe find economies of scale that they never had before as well. So I think as far as the world goes, the world's going to be better because America's going to be better. It's not going to be America's just because we're rich, we have to give everything away. I think that's how some politicians look at it, and they pretend like they're bleeding hearts and they're trying to make sure the world succeeds and shares in the wealth while they're skimming the cream off the wealth bucket day in, day out. So I think it's great that we're making these changes. I've never been, well, I can't say never, but I don't remember being as optimistic, I guess, as an adult in business and just as an American in what I think the future holds economically. Having said that, there's going to be some turmoil. I mean, we've got a stock market that's so grossly overvalued where earnings have not kept up with the price of stock just because we've been printing money. We've got $9 trillion of debt that has to be refinanced, and we're refinancing at a rate of 4 or 5 or 6% instead of 1 or 2 like we were when we issued that debt 5-6 years ago, or even just the last few years. We've got a problem. We've got to dig out of that hole. There's going to be a storm before the calm, and I think we're going into that storm, and I think Trump knows that he has to cause that storm and get through it. I have an interesting analogy just that I just thought of, and I learned it hunting, but it's interesting. Wild game typically don't run from a storm. They run head into it. Cows and cattle, sometimes they run from a storm. And guess what? If they're running from a storm, guess what happens? The storm catches them and goes over, and they're in the storm a lot longer than if they just turn around and run into the storm like I heard a buffalo do. Some rancher in Colorado was actually telling me about this. He says, buffalo run straight into the storm, and they only have to stay in the storm for maybe a half an hour because they're blowing through it, rather than turning their backs on it, running and being hours and hours and even days in the storm if they run across the entire state with a storm chasing them. So we have to keep that in mind, I think, when we look at the storm that we probably go into. And I think Trump is one of those guys that says, you know what, we can't run from this anymore. We've got to fix it, and we've got to put our heads in it. We got to face it, and we got to get through it. And if we do, that storm might beat on us a little bit. We might see some jobs lost. We might see some temporary unemployment, or maybe retraining in order to get new jobs for some people that are being repurposed or repositioned due to these economic changes and some of this, especially just changing our big fat government. Another stat that people forget is the big Omnibus Budget Reconciliation Act, which was called OBRA. That was done during Clinton's time in the early 90s. There was 400,000 government workers that were laid off because of trying to get the budget balance. Well, I think that's the last Democrat I know that really cared about a balanced budget, or at least did more than lip service about it. It did hurt seniors because Social Security taxes went up. It hurt a few people because we had to pay a little bit more taxes in some things in order to get out of debt and get out of that budget crisis that we were in starting the 90s. And once we got out of it, it actually set the stage for the dot-com boom right after that. And everybody thought that Clinton was the best president ever because the economy did so well. Well, the economy did a lot better because of some of the changes that he made in the Budget Reconciliation Act. But give credit where it's due. He did a few hard things that weren't necessarily popular with some of the people that were affected, but in the end, it helped balance the budget for a very short period of time. We can do that again. We might have to just stick our face in the wind, run through it, and get out of it. Trump's only got 4 years. He can't be chasing, he can't let this big pile of doo-doo that has been created by the last 4 or 5 administrations. Trump kind of started getting us out of it, and then COVID derailed that plan and kind of set us back again. And then after that, more and more stimulus that just put the nail in the coffin, so to speak. There's no chance I see that we can't do this without going through some sort of a recession or a reset period. But a reset is good when everything goes back to fair value, when people can afford things, when interest rates go to a place where you can afford to borrow money because you're not paying all your money in taxes and inflated goods that you can't afford because there's a supply chain mismanagement and interruptions and things like that. I feel very optimistic about the things I'm seeing done in politics, other than the complaining on the other side. But as far as the people in control right now, I think they're doing the right things, and I think we should have a lot of optimism. But then again, go through the next storm that's probably ahead. Take it on face first. Be prepared for it. Don't be stupid, and just get through it. And we'll be out on the other side before you know it. And things will, I think, perk up and be happy. And I think we'll look back and say, wow, that really wasn't as bad as we thought.
We're talking with Jeff Oken of Premier Retirement Planning and Wealth Management here on our show, and we've been talking about the state of the economy, certainly the consumer sentiment about how things are going. If you have questions, if you're feeling like you don't understand what's going on out there, we do invite you to give us a call here at Premier Retirement. 520-780-9059 is our number. You can call that number right now and leave your name, telephone number. Shelley will call you back during the week and set up a time for you to have a casual conversation with Jeff at no cost and no obligation. Once again, 520-780-9059, a chance for you to sit down with Jeff. We call this the Retirement Roadmap. We don't necessarily have to just talk about the market and the economy. We can talk about all the facets of your retirement journey. 520-780-9059. You can also find out more about us online at premret.com, premret.com. Jeff, let's switch to our next subject now, which is annuities. You know, an annuity can be a powerful retirement tool, but the wrong one can drain your savings. It can lock you into unfavorable terms or fail to meet your financial needs. So let's talk about some of the signs that your annuity might be wrong for you and what you can do about it. The first one has to do with high fees.
Yeah, fees kind of get in the way of a lot of things. There's a few different reasons why somebody would pay a fee on an annuity. Now, the highest fee annuity that I know is a variable annuity, and honestly, I haven't sold one since 2003. Somebody asked me recently, they said, you know, we looked at your licenses. You don't even have a variable annuity license. You lost it in 2005. I said, well, yeah, that's when I didn't renew it again because the fees are just absolutely too high. I don't see what you can't accomplish by investing your safe money in safe stuff. And if you want to take risk, buy a mutual fund or an ETF with lower fees. Fees on a variable annuity can be, you know, if you layer them, there's just like this mortality and expense charge, maybe 1.25%. Where does that go? The insurance company, the people that sell it? I don't know. It's just a charge like 1+% typically on variable annuities. And then you've got a selection of mutual funds inside that annuity, not ETFs, but mutual funds typically that have a fee. And so those sub accounts that are directing the ups and downs or the upside potential and without mitigating any risk, a lot of downside potential. You've got another 1% in fees probably on a typical mutual fund sub account that's in a variable annuity. And then let's say you want to say, well, you know, I know this variable annuity. I want to make sure that I can get income from it. Well, on a variable annuity, if you get income from something that's variable, the insurance company and the brokerage firm that puts them together, it's where brokerage firms and insurance companies kind of meet together. and they create a situation where, they both want to win, but then the client wants to win too. But if you have something that has high fees and risk, that doesn't sound really that compelling. So what is the reason for an annuity? An annuity is an income stream. So eventually, don't you want to have that annuity generate some income for you? So most annuities have some sort of a rider or an annuitized value where you can lock in the gains at a particular level, and then you get an income for life or an income for a certain fixed period of years. In a variable annuity, many of them have what's called an income rider, meaning we can't guarantee that you won't run out of money, but just in case we're wrong, we'll charge you 1% for this type of rider so that you don't run out of money. Oh, and by the way, if you want a death benefit, guaranteed death benefit, we'll charge you 1%, and we'll make sure that if you put $500,000 in this annuity, that if you only take $300,000 or $400,000 out before you die, we'll give your heirs the balance of what you put in. Well, that means all the gains and all the fees and everything went to pay the insurance companies and the brokers, but none of the gains potentially would even go to your heirs, yet they might charge a fee for that too. Now, I'm not saying all variable annuities are stupid and bad, but they typically can be layered with so many fees that you're into it for 4 or 5% in total fees. Well, how are you going to make money if the market is volatile and it averages maybe 8 or 10, or if you have some sort of a more conservative mix in a variable annuity? Good luck making 3 or 4 or 5%. It might be harder to beat a CD with that than it would be just buying a fixed annuity with a fixed straight percentage. So I have lost my, appetite for variable annuities a long time ago. The big reason was the 2000 crash. The market went down significantly, 2000, 2001, and 2. The annuities were still charging exorbitant fees. So not only were the losses big, so were the fees big, and it kind of exacerbated that, and it made me have a little sour taste about them. Fortunately, at that point, there was a thing came about called indexed annuities, fixed index annuities, where the principal would be guaranteed without a fee, and the upside would be a participation in the market without the downside risk. And the fees were so much lower, if there was even a fee at all. I thought, well, why wouldn't we do that if we're trying to get a safe place we can take money out of and not pay a fee? Now, there are income riders. In some cases, those income riders, like I said, let's see if you can guarantee some income even if the account runs dry. They do have income riders, and sometimes they do charge a fee, and I call that longevity insurance. But if you don't have mortality and expense charges, you don't have excess fees for, return to premium riders and the sub-account fees. I mean, instead of being 3 or 4%, maybe you're paying 1% for guarantee that if somehow your annuity ran out of money, you'd still get paid. Well, that fee's a much lower fee. So you might be able to get the same end result. Oh, and by the way, if there's less volatility in an account, the insurance company that guarantees the income can guarantee higher income. That's another big deal. I usually let math determine what product is right for you. And that's kind of what this segment's about, is how do we know if an annuity is right for you? Do you have a variable that you've had for a long time or kind of wonder why it doesn't really perform, but somehow the income plan on it doesn't really float your boat or create as much income? Well, maybe it's because you have the wrong annuity, and maybe it's because those fees have eaten up a lot of that benefit for you over the years and it didn't play out quite like you wanted to. So you can also look for other annuities, and I'm sure you're going to ask me a few questions on that regard, but that's my take on fees. There are some fees that you have to be careful of when they're layered on top of each other. They can really wipe out the gains and the potential upside opportunities. There are other fees that I think are wise, and that is maybe to insure against downside or insure against income. Or like I mentioned, index annuities. Some annuities might say, we'll give you double this index, but in order to get a better participation in this particular index, a stock market or whatever index you're playing, we can leverage it by adding 1 or 2% of our money to it. Well, if the insurance company is going to leverage it for you and it costs them more, then they've got more on the hook. And so sometimes you split those fees, or sometimes they have a plan where you can leverage the type of the returns you get. So there's all kinds of fees. There's different things you pay them for. I don't like when they're layered on top of each other. I like when you can just pay for what you want. You know what the cost is. And if it makes sense, pay a fee. But they're definitely need to be taken into consideration when you look at annuities.
Jeff, our listeners feel their annuity is not doing the job for them. Maybe they fear they're paying too much fees or their situation has changed. What are the options for them with their current annuity?
I think the biggest thing, not just fees. I mean, I see a lot of old variable annuities. I see a lot less of them than I used to 10 or 15, even 20 years ago. I think because people know that there's another option to get an annuity that guarantees income and still have the upside in the market, maybe just splitting those two categories into a portion of your portfolio, the portion that has no risk and you want income from, and the portion you want at risk, and pay less fees for. So you can kind of balance it with different products and kind of a different arrangement of portfolio management. But what's happened in the last few years is interest rates have been really low. And consider this, if you've got a company, and by the way, I like fixed annuities, fixed index annuities, and just regular fixed straight annuities, immediate income annuities where you get immediate income at a guaranteed rate, or a multi-year guaranteed MYGA type of annuity called multi-year guarantee annuities where you might get 5% a year for a guaranteed 5%. Now, keep in mind, the main reason I like about annuities, fixed annuities, is they're safe. The other reason is that they're fairly competitive if you compare them with CDs and other options that are safe. If you're not in an IRA, you can also get tax deferral on an annuity, which is nice. So you don't have to pay taxes on any of those gains until you pull the money out and use it. In fact, you can roll an annuity from one annuity to another one and roll that tax-deferred benefit to the next annuity as well. We call that a 1035 exchange if it's on a non-qualified or a non-IRA annuity. If it's in an annuity, you can just do a direct transfer from one annuity to the other, and your gains move over, and it's no big deal because if it's a Roth, they come out tax-free, and if it's a IRA, they come out taxable as you pull it out. So many ways you can move annuities. However, most annuities have a particular period of time called a surrender period where you would receive a surrender charge if you pull all your money out. They typically will give you a 7 or 8 or 10% penalty-free withdrawal every year. Some have accumulation where if you don't take it one year, you get it next year. So you can have 20 or even 30% access to your money if you try to tap into it little by little rather than just one fell swoop, wipe it out and take the money. Reason being is that the companies that issue these annuities are investing your money in bonds over a period of time. They ladder those bonds. They know what interest they're making. And if we have a year like 2022 where interest rates go up, the bonds that that insurance company bought to secure your investment go down 20 or even 30%. If you pulled your money out because you wanted a new annuity, guess what? That insurance company is going to lose 10, 20, 30%. And they're going to want to share that loss with you. And so there's usually a penalty period. Many annuities right now have a penalty, a pretty significant penalty, because as these companies, that people bought annuities 4 or 5 years ago that are issued based on a 1 or a 2% interest rate, which is what they were making at the time, find that new annuities pay a lot better. And they do. Because why? Because the insurance company can make more on your money. Problem is, if they bail out of the old annuity, they lose so much money that it's hard to make up on the new annuity. They got to figure out how to find this happy balance. Until recently, there are opportunities where companies will give you a nice bonus in order to pay off that penalty that you might receive on the old annuity in order to get a higher return on a new annuity based on a higher interest rate. And you can do the math and find out if it makes sense. But if you're presently in an annuity, and we find this all the time, somebody bought an annuity 5 years ago, and they might have been able to make 1% on a CD, but they found that they could make 0 at worst case scenario on an annuity, but make upwards of 4% on the upside if the stock market did well. Well, if the stock market does well 7 or 8 times out of every 10 years, like it normally does, your average is 2.83% on that annuity. So people thought, well, shoot, I can buy an annuity and still tax deferred, it's still safe, but I can make 3 times what a CD will make. Well, let's buy that. Well, look, fast forward to today. With a 5% interest rate, an insurance company can invest your money and they can give you 8 or 10 or even 11 or 12% of the upside of the stock market. So somebody's like, man, I'm still making 3% if the market does well, and I could be making 12. Gee, I should move it. Well, maybe you lose 10 or 12% interest, 12% if you move it. And, nobody wants to take a step backwards. However, companies are stepping up big nowadays, and they're saying, you know what if we don't offer you 8 or 10% as a cap on the participation rate? We'll offer you 6 or 7, but we'll give you a 12 or 15% bonus of our money in order to buy you out of your problem. Still make it so if you get hit by a truck, you'll get more out than you would have got if you got hit by a truck with the other annuity. And going forward, if the market goes up 10%, you would have got 3 or 4 on the other one. You'll still get 6 or 7 on the new one, and we'll pay for your exit charge. So there's a lot of opportunities to upgrade annuities right now. Some annuities a few years ago used to lock in income or lock in gains like every 2 or 3 years, and those looking at history paid more. But if you're looking at waiting 2 or 3 years with a volatile market like we've been in lately, we're finding people that have waited 2 or 3 years, had 1 good year, 1 bad year, or 2 good years and 1 bad year, and end up making nothing on their annuity for that period of time. So a lot of people are saying, I don't like that strategy anymore. I wish I could get one that had yearly lock-ins, but I'm going to take a $12,000 or 12% penalty on my $100,000 annuity over here. How to get out of that? Like I said, other companies, A-rated companies, are making enough money on your money that they can dip into their surplus of funds, because insurance companies not only have your money, they have a reserve plus a surplus. And if they dip into the surplus of funds, they can basically buy business from you in order to participate in the future. They can reinvest your money at a higher rate, so they make more. And they invest your money at a higher rate, so you make more. So don't feel bad about, oh no, I can't get out of this annuity because I'm going to take a hit. Well, there's plenty of opportunities where companies are happy to have your business and pay to get you out of that problem. I think it's a great opportunity. It's something that a lot of our clients are taking advantage of. Some clients are just so negged out about taking a penalty, they don't see the benefit, or they're looking backwards instead of looking forward to the benefits that they'll get in 1 or 2 years. I just don't see, how you're not going to be happy if you move to a better annuity that pays more.
If you have questions about annuities, once again, whether or not your annuity is right for you, call us here at Premier Retirement, 520-780-9059. You can also find out more about us online at premred.com. Jeff, time for a break. When we come back, we've got listener questions and more when Premier Retirement continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premred.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thank you so much for joining us each and every week for Premier Retirement right here on 790 KNST, Tucson's most stimulating talk. Of course, we're on the radio for you 4 times on a weekend, Saturdays at 7 a.m., 9 a.m., and 1 p.m., and then at Sundays at 11 a.m. If any of those times are not convenient for you, once again, remember, we're also a podcast. You can go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Once again, if you heard anything on the program today that resonates with you, it prompts some questions, we would love to have the opportunity to talk to you. We're offering this Premier Retirement Roadmap at no cost, no obligation. All it is just a casual conversation with Jeff to get your questions answered. To get yours, right now call 520-780-9059. 520-780-9059. Leave your name, telephone number. Shelley will call you back during the week and set up that appointment for you. Again, it's not going to cost you a dime. There's no obligation whatsoever. 520-780-9059. It'll take you about a minute to make that call. I think it'll be probably the best call that you'll make all year. Okay, Jeff, time for listener questions. We have 3 this week. We'll start it off with George listening to us right here in Tucson. George says, I made the mistake of throwing $100,000 in the S&P 500 in early February. A few days later, I lost close to $10,000 due to a drop in the market, which started towards the end of February. This was my first time experimenting with the stock market. I thought I could give it a try and let it sit for a few years. My current advisor tells me to wait it out, but doesn't give me a time frame. How long do you think it'll take to get back the almost $10,000 that I lost?
Well, I don't know. Nobody has a crystal ball, but I do know that the stock market is so overvalued. You probably bought at the top and maybe the top for a long time. I think there's chances that the market could rally again between now and the time it finally finishes its upside. I think we're going through what has to be a long-awaited recession. We're in a multi-bubble bubble. I've said that there's 6 different parameters that always end in recession. 6 different graphs you can look at, all of which have ended in recession, either alone or with other factors participating. And we've got like every factor out there that points to a recession coming soon. So I think we might see a prolonged downturn. I think the economic speed at which Trump works and makes decisions are probably going to fix things quicker than some of the past big drops. But I think we're due, if we look at what fair valuation is in the stock market, we look at a current trailing 12-month price earnings, we're at $38, $39 that we're paying for $1 earnings in the stock market. And typically it's around 15. So we're more than double the price of history of the average median price range that the stock market typically trades at. And usually after recession, the recession ends lower than that 15 to 16 PE ratio area. So, I mean, we could see it wouldn't surprise me. I hope it doesn't go down this low, but it wouldn't surprise me to see the S&P in the 3,000 range within the next year. If we look at the last 2 times the market fell by that magnitude because of a recession like what I think we're due for. And again, I'm not doom and gloom. I just say, hey, you can protect your money and not have to ride this thing out. You can hedge with some options or go into gold and silver, which typically do well when the market's not doing well. They could also lose money too, but I mean, there are speculative areas. There's some energy stocks and different things that I think are going to be a lot less hit by a big crash, which has largely been pushed up by fake tech hype, which has mostly been AI generated, just like the dot-coms that turned into the dot bombs back in the late 90s and early 2000 crash. The last time the market has crashed by the magnitude that it looks like we're due for, both those recoveries took 5 years or more. So if the market went down, could you wait 5 years? I hope you don't have to wait 5 years. Here's the deal. The best way to not lose money is not having the market in the first place. Now, if you put $100,000 in the market and you had $1 million, you've only got 10% of that riding, meaning you're only down 1% overall. I think you're still fine. And maybe you let the 100,000 ride. I mean, we never know if the market's going to follow history or not. So far, it's done pretty good at repeating history. And I would bet on the side that it will. And I would bet on the side that, even if you got out right now, you're still getting out near what's probably in the long run looks near the top area before the market finally settles down to where they'll probably settle down. Last August, there was a low, and the prior October, there was a couple of lows that I think are next to hit if there are some downturns that would provide some support for the market. Again, I don't know how fast the infrastructure growing and the jobs coming back to America can happen. I think it'll probably be a year or two before Trump's changes or his tariffs actually take effect to start benefiting the U.S. like, the plan shows. So I don't know if the market's going to make that kind of a recovery that quickly, or maybe in anticipation, money finds its way back into the market and props it up. But right now, 60% of American households own stock, which is an unprecedented number. It's only happened a couple of times before. And when that many Main Street stock owners, households, basically private households, own that much stock, and the institutions have unloaded approximately a third of their holdings, including Warren Buffett. If you look at he's got over a third of his money in Berkshire Hathaway, $1 trillion mutual fund, basically, that he runs. He's got over a third of that in cash. So, he's a smart guy. Institutions are smart people. They're unloading it. They're preparing for a bear market. How long will it take to come back? I think it's smart for your advisor not to try to give you a time frame, because nobody knows. And I don't know either. I know what's happened in the past, and they've been 5 to 7 years before on a 50% crash. So you're only down 10% so far, probably down a little bit more since that first 10 days, because the market has been mostly volatile and mostly down from there. But if you're down 10%, I don't think that's the bottom. I think it might bounce a little bit. If you want to try to time the market and get out, great. If this 100,000 is money that you can't afford to lose, then you shouldn't have put it in there in the first place, I hate to say. But it might be smart to get 90,000 of it out while you still can, rather than watch it go to 50 and, have your gut ache and have you lose sleep and ruin the next few years of your life if it does take that long to come back. I hope it doesn't. I hope the turnaround can be quick. I hope it can be as painless as possible. My job is to not let people that have worked a lifetime to save their money lose it in the next market crash. So as I've mentioned on the radio week out and week out, and I know I'm not very popular with some other financial advisors or other financial advisors' clients because they think I'm being way too conservative. Well, I'd rather you get mad at me for only making 5 or 6% in your investments because we were conservative than losing 20, 30, or 40, or 50 and having it take 5 years to get back to even. Because if you look at the S&P right now, even if you look at the last 6 months, the S&P 500 is down about 3 or 4%. In the last 6 months, the S&P is down 3 or 4%. All of our clients that haven't been in the market, and most of our money isn't. I mean, we have very little money that's been market-based, and usually it's younger people that have a long-term time frame, or they have money that they say they can't afford to lose or not using for near-term income. Everybody's been made more than that in the last 6 months if you compare that to the market. So people who were getting all mad and upset and bent out of shape about, but we're not keeping up with the market. Well, look at us now. Now we are. In fact, if you look at the last year, we've actually basically a 10-year bond portfolio, or actually even shorter than that, a short-term bond portfolio kept up with what the market's done from a year ago today. So again, you can do things easy and be the tortoise in the race, or you can try to be the hare, get excited for a few days, but then have your gut ache for a few days. And if you like that kind of turmoil and the roller coaster ride your emotions can take, then maybe the market is a fun place for you. And some people thrive on that. I find that my clients don't typically thrive on it. They kind of like the slow and steady, the tortoise game, instead of trying to be the hare and win it in a sprint. They'd rather be smart during the uncertain timeframes. And guess what? In the next 20 or 30 or 40 years, depending on how long your retirement is, you're going to go through several periods like this. And it's okay to sit a couple of years at a time out, waiting for bad things to happen that we know are likely to happen, and getting back in when it makes more sense, when valuations are smart, when the economy's better, when earnings start growing again at a reasonable rate. The last 2 years, earnings in the S&P 500 have only grown at 1 or 2%. That's pathetic. That doesn't justify our GDP growing like it is. It's not even keeping up with GDP growth. And GDP growth is just based on what? Population and probably illegal immigrants that are making up some of this growth, but it isn't because of earnings in the market. It's because of stimulus money, QE, fake QE, backdoor money to the banks, and a lot of things that have been manipulated over the last few years that I think are going to not be so manipulated going forward, which is a good thing.
George, thanks for that question and for listening to us in Tucson. Again, Jeff's number 520-780-9059. If you have questions, we'll send you out Jeff's book, Retirement: The Road Ahead. Jeff, next question comes from Mike in Vail. Mike writes, I know that money can do many things for you, but not everything. I'm 64 and I want to retire in 3 years, but there's a chance that my company may retire me before that. I'm looking to invest about $250,000 to cover me just in case. Are there any investments that can give me security, cash flow, and liquidity?
Well, I think short-term bond portfolios are still paying a reasonable rate of return. You can get some short-term annuities. I mean, are you looking at this $250 lasting you 3 years? In other words, you want to spend $80,000 a year of it roughly, plus some interest. I think 4 or 5% interest is a reasonable rate of return. I think you'd be foolish, especially if you're looking at the company may retire you early, probably because they're not making the income or the returns that they had hoped, kind of like the economic weakness has gotten the best of your company, perhaps. And that doesn't surprise me. I think your biggest focus has to be, how do I not lose that $250 because I need it to cover me in the next 3 years? I wouldn't put that at risk. I'd be happy to take cash with zero interest in order not to lose it, because not losing is winning, especially in the retirement game when you need that money for income. Let's say you did take a little bit of risk and it went down like the last guy did, $25,000, $30,000. Well, would you rather live on $60,000 a year for the next 3 years, or would you rather live on $80,000 a year for the next 3 years, or maybe even 90 if you make a little bit of money? But I wouldn't say, well, I really want to make it 100. I need to make 10% a year on this money, and if I can, I'm just not interested. Well, then you better get a new job. Is that going to be available? I don't know. Maybe in a few years there'll be new jobs available, and you can make up the difference then. But I think you need to be very cautious with that money. Anytime it's short-term money and you need income from it, you need to keep. And if you want liquidity, and you need to keep it liquid and something safe, and that would probably be short-term government bonds. The other thing you could do, you can even get an immediate annuity for like a 5-year payout and probably have an internal rate of return of about 5% on it. That would just give you a monthly payout. You might want to just put it aside in a safe place. Then if you do end up retiring, then look at what the rates are and then see if you want to lock up sort of a monthly income, or if you feel more comfortable leaving it in a liquid form. But there's a lot of things out there. I mean, the stock brokerage firms are not the only world to look at. There's some insurance products that might help you. Banks might have CDs or laddered CDs that might help you depending on the rates. But there's several ways to skin that cat. And when that time comes, if you want to give us a call, we'd be happy to help you.
Mike, thanks a lot for that question. In Vail, again, Jeff's number 520-780-9059. Okay, Jeff, final question this week comes from Andrea, listening to us in Sahuarita. Andrea says, I'm 67 and want to retire this summer. I have a plan that allows for about a 4% withdrawal rate that will meet my basic expenses and a few fun things. I'm worried that Trump's tariffs and trade wars will increase costs across the board and make my 4% withdrawal rate come up short. Do you have any advice on how to design a rate of withdrawal taking into account the unknown?
There are some conventional ideas about taking into account the unknown. The thing is, if you're trying to get income, you don't have to have unknown. And that's the thing I think is such a misconception. That the plan allows for a 4% withdrawal rate. That's called the 4% rule. And by the way, that's been totally obliterated in the decade between 2000 and 2010. If you would have used the 4% rule between 2000 and 2010, you would have been sorely mistaken and sort of unfortunately surprised that your money is not going to last at that withdrawal rate, the 25 or 30 years that it was intended. That's what the brokerage industry says, should be a nice withdrawal rate based on a split between stocks and bonds. Now, it's interesting that stocks on average earn about 10% per year over the last 100 years or so. The bond market, let's say 4 or 5%, kind of on the low end, maybe even higher during some periods of time. So if the bond market averages 4 or 5, the stock market averages 10, how is it that you can only take 4% out of that based on the rule of the 4% rule, which is what the industry says is a wise enough rule to be okay with and not get in trouble compliance-wise or have your insurance have to cover somebody's losses if at least you recommend some sort of a conventional withdrawal rate. So if you have $1 million, you can only take 4% out of that, $40,000 a year. Well, that kind of stinks. If you're 67, what if you could have an 8% withdrawal rate and only put $600,000 of that $1 million in it and have the same exact income forever guaranteed, and then still be able to have another $400,000 at work for you that you could keep liquid, that you could take a little bit of risk in because it's more long-term money and you might not need it in the near term. Or maybe you put $200,000 of that extra money in something safe so that you can supplement your income for the next 5 or 10 years, and then have a long-term strategy where you invest in the market and you go aggressive, knowing that in 10 years, it's very unlikely that in 10 years you'd have less than you have now. Typically, a 10-year period is enough to guarantee, historically, not guarantee, I can't say that word, but to be fairly certain or predictable that you'd have some gains in there. Again, it kind of depends what your stomach will, allow. But what if instead of taking a 4% real rate or $40,000 out, what if you could get an 8% rate on $800,000? What if you could get it from $40,000 and make your income go up to $60,000 or $65,000 a year guaranteed and still have a couple extra $100,000 in, what if I need it money? Maybe pay off some bills or have something that just generates some extra income or fund money if the market's good and you don't take that extra vacation if the market's bad, but you're making $20,000 a year more than you would have if you just kept the thing in your plan with the stocks and bonds that the industry would like you to keep, because they love to get those fees and get paid over and over again on the same money for the rest of your life. You can lock it up and guarantee income and still have access to the balance of that account should you need it for a nursing home, should you need it in 8 or 10 or 12 years, depending on the contract. If you just want to cash it in and not take income anymore, you can do that. Or if you die, your heirs get the balance of that account. You don't have to give it away. There's a lot of things. This I'm talking about is index annuities with income riders. There are some great payouts. People who are using them are very happy. They give the peace of mind they want so that they don't have to worry so much about the other money. In your case, this 4% rule means that you should be worried about the whole enchilada. You're going to be worried about the whole thing. And I'm sure a 4% withdrawal rate to meet your basic expenses are a few fun things. I'm thinking you must have close to $1 million in that account. I mean, do you want to worry about the whole $1 million, or do you only want to worry about a couple $100,000 of it and have more than that income guaranteed by a company that not only has your assets, that guarantees your assets, that secures your assets, has insurance behind those assets, reserves behind those assets, and in a product that's never lost a dime since these products have been in existence. So, consider some options, expand your horizons outside of the brokerage world where you're at, and you'll find out that there's a lot of things that'll make retirement feel a lot easier, more secure. And the only thing bad I have to say about it is if you just really love your broker and you just feel bad about saying he's done a great job for the last 40 years, but you have to go a different direction and do the right thing for you for the next 40. So I think that's really probably the only hitch that you have to worry about. But if you see the numbers, I think you'll be pretty happy to know that you can do a lot better than that 4% rule.
Andrea, thanks for listening to us in Sahuarita. And of course, you'll get Jeff's book, Retirement, The Road Ahead. And as always, if you'd like to talk to Jeff, 520-780-9059. That goes for anyone listening to us. You have a question for Jeff, you'd like to sit down in a casual atmosphere. Again, this is not going to cost you a dime. There's no cost, no obligation, no judgment. You can call 520-780-9059 and talk to Jeff. Maybe you got a plan someplace else. Bring it in and let Jeff look it over. If you don't have a plan, come on in and we'll talk to you about what your lifestyle is, what your dreams, your hopes, your goals for retirement is, and design a plan to meet those goals. Again, no cost, no obligation, 520-780-9059. You can also find out more about us online at premret.com, premret.com. Jeff, a lot of people listening to the program today may try to do this themselves. And I don't know, retirement planning seems to be a little bit complex. So let's talk about retirees who don't use a financial advisor. They often do make some costly mistakes that can affect their long-term financial security. What are some of the common pitfalls here that people make when they don't use a financial advisor?
Well, there's a lot of things. First of all, when they don't use a financial advisor, they very likely don't know about a myriad of other opportunities that they could, or investments they could make, especially if they're dealing, and I say advisor, registered investment advisor is typically a fiduciary, but you can be a registered investment advisor and have a license, a Series 65 or whatever the license is, 67, that you get in order to call yourself a fee-based advisor. It's supposed to be a fiduciary and only trade stocks and bonds. Well, there's a lot of advisors that do that. Now, I'm going to answer this in the context of an advisor like myself, who's more comprehensive, that understands tax planning, income planning, Social Security maximization, how to involve life insurance annuities in conjunction and dovetail into a stock and bond portfolio where you get the best of all the worlds that are out there, the cake and the eat it too type of thing. And there's plenty of icing on the cake if you just look at it. So I think a big part of that is just understanding how many options outside of the Wall Street world there really are that are explicitly developed for a retiree to minimize things like longevity risk. For example, people are living longer. That 4% rule that we just talked about in the last segment where, 4% is what my plan says I can take out. Well, what if you can take something out that doesn't have longevity? By the way, that 4% rule is only based on a projected rate of return over about a 25-year retirement period. Well, if you're 65 when you retire and you're 90 years old, well, then that 4% rule really is outside the bell curve of probability of succeeding. So what about maybe you underestimate the fact that you could live to 90? 40% of the people that reach age 65 healthy are going to be 90 or more. I mean, that's a lot. 10% are going to reach age 100. Well, could that be you? Well, maybe nobody believes it, but sometimes they get there and realize, wow, I really did it. People aren't planning on living longer than they expected. And without proper planning, you could run out of money. I mean, with the annuities with income riders that last a lifetime, regardless of whether or not there's money in the account, I think are one way to not worry about the longevity risk is basically you buy longevity insurance. I'm going to get paid as long as I live. Another big one is mismanaging the withdrawals. Some people say, oh, well, I want to withdraw more money now and less money later, and find out that through a couple of extra emergencies or whatever, just because their plan says, well, I can live on 120,000 years, doesn't mean you have to. You know, if there's an emergency, then you end up dipping into future incomes. You might want to make sure that there's enough buffer for good times and bad times, and making sure there's enough to enjoy retirement and have that predictable income, but also having enough set aside for emergencies and those unforeseen things, not to have to dip into what would be your future guaranteed or predictable income. Many people don't plan for taxes properly. So many people I find go into retirement thinking they're going to go into a lower tax bracket. They've been a great saver their whole life, and now they find out they have a multi-million-dollar 401k or an IRA that has to be withdrawn at age 73, 75 if you were born after 1960. And some of you are already finding out, like, wait a minute, my required minimum distributions are going to go up every year. So if I make money on my IRA, my taxes are going to get worse and worse, and I'm going to go into a higher tax bracket. Well, that might be you in 10 years. If you're in your 60s now and you haven't really had to worry about that, you only take out what you need and you can manage your tax bracket. Well, wait till you're forced to take money out and you can't manage your tax bracket anymore. You might want to do some pre-planning and actually cash in some of those IRAs, live on some of those IRAs, maybe wait longer on your Social Security and use more of your savings so that you don't have a tax problem in the future. Or maybe do some Roth conversions where you pay taxes now on less money at a lower tax rate than you will on more money at a higher tax bracket later. So again, the math usually rules the decisions in my office. And if the math proves out, I mean, we have great ideas, but if the math doesn't support it, we don't do it. But if we can see that you're going to pay a whole lot more in taxes and have less to spend on you and your family and your legacy plan on your heirs, than if you pay taxes now on some of the money at a lower rate, then we're going to choose the one that has more money. It's what you keep that matters. The more money going to you than going to the tax man. In some cases, it's better not to pay taxes because you'll never be in a high enough tax bracket based on our projections and based on how conservative your investments are, or based on the mix of assets that you have. Sometimes you're in such a high tax bracket, it really doesn't matter if you pay taxes now or not. You've done so well that you're always going to be in a high tax bracket, and we might have to make some really hard decisions. How bad do you want it to get to be for a short period of time in order to curb taxes in the future? Again, taxes are a huge deal. Ignoring inflation is, I think, that sometimes comes up. People don't really consider it. But I think more often they consider it's going to be a bigger deal than they think. Here's what I found is people want to not spend money in early retirement because they're so afraid that when they're 90, their cost of living is going to be 2 or 3 or 4 times what it is today. I have found that to be absolutely not true. The fact is when you're 60 and 70, you're in the go-go years and you want to do stuff and you want to spend money. When you're in your 80s and 90s, you do very little and you don't need a lot of extra money. You don't buy new cars every few years like you do when you're in your 60s. You don't go to Bora Bora and stay in the Four Seasons and the huts over the water anymore because the travel just kind of gets you down. You'd rather just go to Scottsdale and enjoy a time weekend golfing or whatever. And so life actually gets cheaper as you get older. That's what I've seen in 35 years of planning and watching people start retirement and end retirement. And it's very common to see people spend less, even with inflation being a factor, than they would. Now, if inflation stays at 8 or 9% like it was a year or two ago, I mean, yeah, that's a whole different story. But the fact is it doesn't. Even high inflationary periods of times and stagflation doesn't last forever. The economy will fix itself. It'll right the ship and we'll be in better times where the 2 or 3% inflation rate will probably be real. Keep in mind that Social Security does have an inflation adjustment on that. Some pensions do. And if you want to build in a buffer, what we usually do is just build in Roth IRAs or other accounts that you don't touch so that if inflation does become a factor, there's always a pot of money you can draw out of that hopefully doesn't push you into a new tax bracket if you need something, either extra income or an extra expense, or some medical situation comes up, or heaven forbid, you need to move into an assisted living facility or one of the care home type communities where it might cost a little bit more, that you have that extra buffer in your estate so you can plan for those things as well. So those are just the things that came off the top of my head. There's so many different things we can talk about. And if you want to know what I find, people come in and they bring their concerns and I find out what they're missing with their other advisors or by not having an advisor. So if you want to have that discussion, we're certainly open to it and would love to invite you over.
So if you're DIYing it, or maybe you have a plan someplace else, you want Jeff to take another look at that, we would love to talk to you. No cost, no obligation. 520-780-9059 is our telephone number. You can also find out more about us online at premret.com, PREMRET.com. Jeff, we just get started, then we run out of time. I want to thank you for your time, but most importantly, I want to thank our fine listeners for joining us here in the greater Tucson area. So for Jeff Hogan, I'm Jeff Shade. Have yourself a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.